One. And welcome everybody to another Smart Money Circle update. I'm Adam Sarhan. With me today is a very special guest. We've got Stephen Orr, who's a longtime trader. He's got a lot of wisdom to share with us. He's done a lot. So without further ado, Stephen, welcome to the show.
Oh man, Adam, thank you so much for having me. Smart Money Circle is an awesome place to really get to know traders and their journey of how they got to where they are.
Thank you so much. I appreciate it. I'm glad that you're a fan of the show. And
Sure.
thank you for coming on. And that's going to be my first question. Can you tell us about your journey and how you got to where you are today?
Absolutely. It's so funny when I was growing up, kids wanted to be astronauts or firefighters. I wanted to be a stockbroker really badly. At the ripe old age of 6 years old, my parents didn't even know what that even meant. They had a broker, right? But they were like, what did we do wrong or right? That he wanted to be a stockbroker. And so my parents brought me to their broker every once in a while. And she, for the most part, wasn't that friendly to me as a kid. She really didn't think that I would, it wasn't my path, right? And I've had that issue a lot of my life, right? That, well, can he handle it? That kind of thing. And so my mom and dad did that. They kept bringing me and kept saying, okay, well, that's what you want to do. We'll do this, right? And I did. At the ripe old age of 14, 15, and 16. I still have it today. My first Disney check,
Nice.
dividend check of about 30 cents. I still have it today from 1991. I just told myself how old I am. But what's interesting is I've always had that in my blood, but the path of becoming a trader and all that is not always easy, right? And even on my own shows, I always ask the same thing, because everybody can do that, right? Anybody can be a trader, but you can't be a trader overnight, right? It takes time and energy. And so I started at around the age of 17, 18, going to trade commodities. And at 18, I was actually legal in my own accounts. My parents' not accounts anymore. The trade, and I started to learn commodities. So I actually had to drive an hour and a half each direction to Kentucky, which had a lot of
Wow.
Sturgis, Kentucky, Jesse Curry commodities, and it was tough because the bond pits opened very early in the morning, even today still, and then I waited till the bean pits were closed, the bond pit started to close, and then I could drive an hour and a half back home. So it was a very long, and I actually got into car wrecks because I fell asleep. It
Oh,
was
no.
too much, right? But that
Wow.
was the kind of dedication that I had even back then. But even doing that, I had to learn on graph paper and pen. There was not the computers that we have today. So I have also seen that journey of technology in the space as well. So what's interesting that from there, in 1991 and 92, there was a election happening. It was a presidential election. And so I decided to go off and go work on a presidential election. And eventually I wound up on the Clinton campaign, of which we ended up winning. So off to Washington I went. It didn't stop my journey, though, being a trader. I continued to trade even throughout the time. What was cool was I was in the catbird seat, right, when it came to what was going on around the world. And that was one of my rules is in trading, is that when you are trading, the whole world matters, right? And so what happens in Japan will affect us here in the United States. And so I got a chance to see my trading grow because I was able to see it from a macro, more of a government aspect, how wheat is moved from certain countries. Now we're seeing it a lot, right? Ukraine and Russia, how things are moved around the world. And it gave me an even better perspective on trading. And then I moved off and I started trading silver quite a bit and gold and precious metals. Continued to trade, and then over time I was going to become a full-time trader again, and I did, and I found Money.net at the very beginning of Money.net. What was really cool about that is I went from just using the software within a few weeks to actually being an employee of the company again.
Right.
And yeah, so that was a great time, right? I got to help build a software based around traders and institutionals and became the squawk for that. And then the founder there at Money.net passed away, H.L. Van Arnhem. And then I went off to Benzinga for a while and helped with that growth of that company there. And then Money.net started up again with a great CEO, Vincent Sangiovanni, who was just at GTX. And then they brought me back in to now see the brand new growth of Money.net. We're the fastest growing platform out there, bar none, because of what we're adding. We believe at Money.net it's not just sufficing with the data, but also bringing to traders the actual tools that they're needing. And when the tools change, we're going to change with it, right? That's what I've been saying, is that from the beginning of when I got started to where we are now, the technology has changed so much. I actually last night put on my Oculus and was able to trade through my Oculus. It was crazy.
That's awesome, Stephen. What a great story so far. So, okay, you've got a bunch of trading rules. Don't have time for all of them, but can you pick, I guess, pick out a few nuggets that you'd like to share with us, and we'd be very appreciative.
Oh, it's interesting. When I first got trading, there were two companies that were vying for, a big run, and I thought it was going to be a really big run. And it was cool. It's in the entertainment industry and in the movie business, and it was one called First Miracle Pictures, and another company was out there. And I just taken this big pot of cash. I'm like, okay, you know what? I'm going to put this to work. The stocks are in the penny stocks. I'm going to play the penny stocks, and I'm going to do this. And I did. And instead of buying a little bit of each, I bought one of one. And I bought First Miracle Pictures, and the company went bankrupt and I lost my money. The other company was Lionsgate Films. So if I had kept that money and not put all my eggs into one basket, as they always say, the old adage, today I probably would be with Elon Musk hanging out. But today I'm not. So it's crazy. I always say to people that, if you want to get started in trading, you can always read books. And I always tell people to read books as much as you can. Yes, I get it. It's the old way of doing it. Now there's YouTube, and trust me, we have our own YouTube. I understand that. But you don't really get to understand the deep darks of certain people, right? Like Edwin Lefebvre, who's reminiscent of a stock operator, or my favorite. And I tell everybody, people always ask me, what's the first book to read? And that's One Up on Wall Street by Peter Lynch. Why is that? Well, he was a golf caddy at Fidelity Magellan, and let's be honest, I mean, he took the whole CEO thing and went straight to Fidelity Magellan, and he exploded based on one prospect. And that prospect was this. He said, look, buy what you know. One of the things that he says is he was going to the grocery store and his wife was buying pantyhose, in a little carton, and he thought that was great, and he bought Hanes brands, and it was his first big 10 to 100 bagger, right? It's the same thing when I see people out there trading, and I always ask the first thing, well, what do you do in real life? Well, I'm a plumber. That's great. Why are you buying biotech stocks, right? Home Depot, Lowe's, you go to, is it a good time? No, it's a terrible time to buy. Then why are you buying it, right? That's exactly right. And they always do well. So I always say trade what you know. And then another rule that I always say is I don't believe in hope and luck. Hope is not a strategy. So don't try to hope and luck the world, the market's up for yourself.
I love it. So I've got both those books here. We've got the One Up on Wall Street. Big fan. Buy what you know, buy what you love. Here's the Reminiscence of a Stock Operator from Lefebvre. And then I've got my book too, which is Psychological Analysis, which I'd like to throw in the ring as well and send you a copy if you'd like.
I want one. I'm going to go get one only if I can get it autographed by you, Adam.
Deal. On the air. I'll send you a signed copy. Afterwards, just send me your address and I'll send you a signed copy.
I love it.
So I'm a big fan too. I started from nothing and self-made and all that kind of stuff. And I read all the books as well. And you're right. There's something that it's almost like a quality where it's very difficult to explain until you experience it. But once you experience it, you know it. It's kind of like green. What does the color green look like? Or what does chocolate taste like? You can't tell me what chocolate tastes like, but once I taste it, you can't give me vanilla and be like, oh, that's chocolate. I have to taste it to know it's not chocolate. So it's the same thing with the books. I'm a huge fan of reading, and I've got my libraries filled with all these books too. So before we go to Hope and the other some of the other trading lessons you want to share, let's go back to the books for a second, if you don't mind. What are some of the other books that you recommend? One Up on Wall Street by Peter Lynch is more of a fundamental book. Buy what you know, buy what you love. Jesse Livermore / Lefebvre's book, The Reminiscence of a Stock Operator, is phenomenal. Are you more of a fundamental
sell or go fishing, right?
Yeah, seriously. Yeah, exactly. So once you guys read the book, or if you haven't read it, you'll know, you get the reference. But what are some of the other books, Stephen, that have really made an impact on you, and why for each book, if you don't mind, just like a sentence or two?
Yeah, wealth preservation to me is one of my rules, right? I think it's a key to building, whether you own a home, whether you own stock, IRAs, precious metals, what art on the walls. I think it's the book The Richest Man in Babylon by George Clason. It tells you and kind of puts you in the mindset of, look, there's going to be ups and downs in the market. It's going to be ups and downs in any market, but that wealth preservation, and create several lines of fundamental money coming into you, whether that be dividends, whether that be lines of credit, however you got to bring money in. Make sure it's not just one line. If you're just working to get a paycheck, you're just working to get a paycheck. You want to create other investments that continue to pay you even when things don't look too good.
I love that. That's so powerful. It's a great book too. Thank you for sharing. All right, so we've got read the classics, and then it's hope and greed. What else would you, or don't hope? Just trading on hope is not a strategy. Would you consider yourself more of a technical trader or more of a fundamental trader, or both?
I'm a little bit of both. I mean, I tell people all the time, learn everything you can about technical analysis, right? That's very, very important. You need to learn every single indicator out there, but don't put every indicator on your chart. You don't want to have what they call paralysis of analysis, right?
Right.
Where you have too many lines on your charts. Know when to put them on. If volume is heavy in the markets, then have certain types of indicators on, like RSI, right? But I'm also a fundamental trader. For example, over Friday, when the market got a little over its skis, right? I said, you know what? I saw some stocks that got beaten up, like United Health and Cigna. And I said, you know what? They got beat up too much today. They're up 3 or 4% right now. Looks like they're more than that now. I'm trying to find places that has a benefit of both, right? Technical analysis tells me where price has been, and fundamentals tells me whether or not that's in the right area of where I should be buying. Now, one of my other rules is always have powder. It's very important, right? If you don't have cash to buy, you're out of the game, or you're at the whim of the market, right? You don't ever want to be there. When you find deals, you want to be able to buy. I also say, don't wed positions, right? So, for example, I also say this all the time. When a trade is over, move on, right? So many people just want to continue in that position forever. A good one example of that was Goldman Sachs. I ran it up for 33% over the last 6 months, and Friday I sold. Why? Because I had a nice 33% run, right? It may go higher, I get that, but I took my money and said, you know what, thank you very much, right? I also believe in this, if anybody learns anything about me, is I always say, don't chase the market, let the market come to you. There is so much FOMO in both directions, right? Whether going up or going down. I don't like that. I like being a ticker taker, right? I like being the one when the market's getting crashing and falling and I'm finding good quality companies. You know what? I think I'll pick that up. And then when everybody's rushing to the exits or trying to get out, I'm there selling to them, right? Or I'm already out. Thank you very much. I want to be that person, right? And I want to impart that knowledge to others. I want everybody to be winners, right? But it's not the way that the world works, right?
Right.
And so,
right.
you always want to have an exit strategy. Another one of my rules, always have an exit strategy, because you know what, if you're trying to pull out, if you're a fast trader, like you're a very high frequency trader like myself, sometimes I'm in and out in 3 seconds. Make sure you know what that exit strategy is. Understand why you're doing it, right? But if you're also a long-term trader like I am, also understand why you're doing it, right? Why are you buying Walmart so cheap? Why are you selling Walmart so high up here? Why are you buying Amazon? Have a thesis. I think if anything of a trader that I am, it's a thesis trader. I want to have a reasoning behind of why I bought something. I don't care if it's only for 1 second or 100 years. You need to have a thesis. And if your thesis is broken, then don't be wed to that position.
I love that. So that's a perfect segue to my next question, Stephen. How do you handle risk, and what are some mistakes you see people make with respect to risk management?
That's a very good question. Risk management is the key to all the market, right? It's keeping your positions to a place where you don't feel so uncomfortable. And I always say that's another one of my rules. If a position makes you nervous, you're too heavy, right? Try to keep those positions down. I also don't go full, as I call full boat. Or another trader I know says, I'm doing a thing, right? You don't want to do a thing, right? You want to make sure that you are protecting that. So if you know you want to buy 100 or 1,000 shares of something, divide it by 10, divide it by 4, right? Lever in and lever out. You don't always have to go completely in and completely out. You always want to make sure, because if you buy something and it goes a little against you, great. That's great. You can buy more. If it goes up for you, great, then you can buy more, right? You always want to make sure you're in a position that you can lever in and you can lever out.
So it doesn't have to be all or nothing. Like you're saying, it doesn't have to be all or nothing.
Absolutely. And I also say to risk management, learn options. Um, right now, we're seeing these zero DTEs. We call them death contracts here. You know, very simple. That's not what options were ever meant to do, right? They were meant to be insurance. They were meant to gain some leverage so that if you didn't have to put as much money down. That's great. That's what they were for. What's happening right now isn't quite exactly what they're supposed to be for, right? But options can protect your portfolio, right? So if you have your long stock and you're heavy, you can lever that down a wee bit by buying puts against it, right? In case it goes against you. And if it does, and then there's straddles and strangles and all kinds of different ways of levering that option. And I'm happy to teach that too as well.
Right, I love that. So maybe that'll be another segment or a program or something, but
Sure.
the options are, we can go on for hours. So, okay. What about stop losses, Stephen? Are you a fan of those, or you don't use those?
I do use stop losses, but not the way that most people do. I believe that an organization that, if whatever you would trade with, needs to have trading stops in a way that's trailing. So trailing stops allow you to go into a position, and when you're up a certain amount, I then add the trailing stop. So I'll put a stop in and say I start a position. I will put a position of a stop in maybe 5 to 10% below, somewhere in that range, right? As the stock moves up or down, if I'm shorting, if it goes up, then I will take those stops off and then I'll put a trailing stop in. Why? That protects my portfolio automatically, right? So whatever it is, and people always ask me what that percentage is, it's roughly about 10%. So trading stops are what protects your portfolio.
No, I love that. So it sounds like you've got multiple strategies that you do. Short term, you said 3 seconds, you're in and out of a trade, but you also do intermediate and longer term trades.
Sure.
Do you have a preference? Are you like 80% of your trading is long term, or 80% short term? Or is it 90-10, or what kind of, how would you divide?
75% of my portfolio is long-term stuff that I stick away that I never look at ever again. And it's in wealth preservation, right?
Sorry, you said 5% or 95%?
75%.
Oh, 75%. Okay.
Yes.
And then 25 would be short term?
Yes. And out of that, maybe 5-10% I've kept in crypto and things that are even more crazy. But I love it, right? It's what we trade for.
Yeah.
But when I say wealth preservation, when you make money, go shove it away, right? Go shove it into that 75% fund that you never see. Let it build. If it goes up, it goes down. Don't worry about it. Just forget about it, because there's always one way the market always goes.
Yeah.
Always goes from bottom left to top
Yeah.
right.
Right.
It's just time frame, right? No matter what it is. When I've been listening to this whole thing about FTX over the last couple of weeks, and I go, people always ask me, what should I be doing? I said, buy. Why? Because we've had Lehman moments, we've had 2008s, we've had .com bubbles. Gosh, I remember watching my parents in '87, not knowing what to do on Black Friday, right, and Black Monday,
Right.
next Monday. You know what? The IBM stock and Coca-Cola stock is not where it was during 1987, right? So if you're long term, it's not hard to understand. It goes from bottom left to top right.
Love it. So, okay, people are going to ask, so I'm just going to ask it now. How do you handle risk with respect to your long-term positions? Do you use just wider stops, or you already have a cushion and you let them go? Or
I let them go.
Trailing?
There's no stops in my long-term portfolio. There's no reason for it, because I'm making good quality stocks, buying them for long term, and I keep my eye on it very tight. Now, I know a lot of people can't do that. They can't keep their eye on their IRAs or 401k plans and things of that nature. But I don't really need to, right? I don't ever feel the need to. Because why? Because I'm adding to positions, right? So if a position falls against me, let's say Apple falls down. Okay, Apple's not going away just yet, right? Great. So I will add to Apple. And if I do see stocks that are, they're making some big bad mistakes, then I get nervous, right? And I go, okay, you know what? If I'm nervous, why? Position's too big.
Yeah.
That always, and I always say, always have powder. It goes back to my rules, right? As long as you have a thesis of why you're keeping these stocks, I have no problem with that. And I'm an aggressive trader too, and I'm an aggressive an investor. But at some point, you have to understand that risk reward. There's a level of which you shouldn't have to put in your portfolio, right? If your risk is getting too crazy, then slow it down a little bit.
No, I love that. Okay, so how about timeless lessons that you like to share with the audience?
Yep, the market never sleeps, but you should. So many times I see these traders, and I've seen it for years and years in New York. They're going out partied one night, and they try to go do it the next day and just can't do it. Get a lot of sleep. Get make sure you're up and running around. Look, I like to go out and party too, but on Friday night and Saturday. But on Sunday, you better be studying the markets because China opens up at 6 p.m.
Right.
and you need to be ready to go, right? Because it's not an easy market. These are it's tough, right? One of the things that I've always said, the price of anything is to the least resistance, right? So if you're looking for equities, right, it doesn't matter what it is, a gallon of milk or whatever you're looking at, art, right? The path, that path, right? When you're looking at buying something or selling something, where is it going to, right? You need to understand technical analysis. You understand your thesis. You need to understand all that. But we saw this in the last few months where the market just kept falling and kept falling and kept falling and kept falling. Well, the path of least resistance, or that price of stocks, was not to the downside. It was to the upside because that trade got crowded. And if I can tell anybody else, get out of crowded trades. Let me say it one more time. Get out of crowded trades. A good example that'd be, we've seen the oil markets, right? We've seen oil companies just explode to the upside. Yes, they're going to continue to go up for a little while, but at some point they're going to fall. And when they fall, that's going to be a good time to buy, right? Or you could take advantage of it now, but I'm not going to try to pick tops and bottoms. I don't do that. I look for longer term theses, trying to figure out where we're going to go in the future. That's what the market's all about. Most people think the market's about right here, right now. It is not, right? Normally in the past, markets are about 6 months in the future, right? You are pricing. It's why you have price to earnings, right? PE ratios is why they're higher than 0, because your price is, you're looking at the earnings of the stock based on earnings in the future. So when PE ratios get really low or get tightened up, I look to buy those kind of companies, right? That also helps you, right? If you get PEs down to 14 and 15 and your average is 18, 19, and 20, you're getting stocks that are cheaper than the average. It's not hard. It's not rocket science.
No, I love that. So yeah, actually, I have a concept in my book. It's called time arbitrage, which speaks to that exact point where most people are too myopic or they're too focused on the leaves on the trees and they miss the trees, let alone they miss the forest. So
they miss the whole forest, right? Yeah.
So, okay. Timeless mistakes. What are some timeless mistakes you've seen people make that you haven't shared yet? And how do you avoid those mistakes, please?
Okay, so I would say one of the biggest timeless mistakes that I make, and it's another one of my rules, is I always say this: sitting on your hands is a trade. So often traders feel that knack, that need to get into the market. And when you're investing, it's not gambling. This is not gambling if you're investing, right? It's gambling when you're buying, a crappy crypto you don't even know anything about. That's gambling, right? This is investing. And sometimes the investors and traders just have to be in the game. You can't stand it. You got to be in the game. And I was that kind of trader. And I had emotion in my trading that I was so emotional. I got to get in. I got to do this. I got to move this. When I realized that I don't have to do that, and to start to chill out my emotions and to really bring myself into thinking it's just a numbers game, then I became a much better trader. So I took out all emotion in trading. Win or loss, I did not get excited. I didn't dance around the room anymore. I didn't pump my fists in the air when I did really well. I said, good, let's move on, whether it's bad or good, right? The only time that I ever get unhappy about a trade is when I make money and I don't know why I did it. If I invest in something and the stock goes up, way up, and I don't even understand, my thesis wasn't there, nothing, but I still made money, or I put the wrong size on, I made a fat finger trade, or something just goes wrong and I don't know why I made a mistake, that's the only time I ever get down on myself going, I don't know why I did that. How'd that happen? Why? Because I want to learn from my mistakes and I want to learn from my wins too.
I love that. That's so powerful. So even if your thesis, well, so you're saying is if your thesis is wrong, so you thought the market would go up because of X, market went up. So you were technically right, but your thesis, the logic was wrong. It went up because of Y. You're going to learn from that because you want to adjust and make sure you're in sync with the market.
Right.
You want Y to be your thesis, not X. go up for the right reasons, and you want whatever those. That's really, really smart. It reminds me, actually, Stephen, of a few documentaries I've been watching recently. One about David Geffen, another guy about some of the famous musicians, but not the musicians, but the producers of the musicians, Quincy Jones and a
Oh,
few
sure.
others, Carl Davis and stuff like that. These legendary guys. I mean, these are top 1% of 1%, the smart money, if you will, of the music industry over the last several decades. And one of the things Clive Davis would say, and Geffen said it too, and these are separate documentaries, but I just saw a pattern there, is they'd always look at the top 40 list and the top 10 list and then the top 5 list and then the top songs in the market, so to speak, every single week. And they would make sure that they're in sync or in harmony with what's in demand. And as the musical shifts or the demand has changed over the decades, they would change as well. So what you're saying here really resonates very, very well with that. I love that. Thank you. Next question. What advice would you give your 20-year-old self or 30-year-old self?
Two things. The first thing that I think I would give myself is admit mistakes. Another rule of mine, right? Sometimes our ego gets in the way when we make mistakes. No big deal. Learn from the mistakes, right? As my dad always says, it's okay to make mistakes. Just make sure that you learn from them, right? And I didn't do that at the very beginning, right? I just kept on doing the same mistakes over and over and over again, and until I sat down and actually made my rules and became a confident trader and took the emotion out of it. I wish I could go back and say to that younger Steve, hey, buddy, chill out. It's going to be okay. Everything's going to work out. As I always say, this too shall pass, right? We look at all, FTX today, right? It's going to pass. We're going to get through it. It's okay. 2008, yeah, it sucked, but we're going to get through it. It'll pass. .com, yeah, it sucked, but we'll get through it. It'll pass. I mean, I bought pets.com and AOL and all the things and Netscape, and those stocks still stick in my head, right, from back then. But it'll be okay. And I didn't, right? I got excited about pets.com. So, but you know what? Chewy's the one that came and made it, right? We don't know which one's going to be right. As I said earlier, right? Instead of putting all your money in one stock, maybe you spread that out into an area. You said it quite nicely a little bit earlier about how Quincy Jones would look at the top 5. Well, instead of investing in that one song, invest in all 5 of them, and then whatever song hits is a little bit better, right? So spreading that money out a little bit also is good. But my very number one, I guess, and I've said this a million times, my very number one rule, and I think everybody should know this: if the market doesn't humble you, you ain't playing it. Which means that you still gotta be in the market, right? But it's going to humble you. It's going to say your ego is big. We get it, but the market's bigger. It's like when you're a fish pond, right? You're not going to be the biggest fish. Never. There's always going to be a bigger fish. You're going to get gobbled up. I remember when the Wall Street Bets group was so happy about AMC and GME, and they made a fortune in it, and good for them. Then the next move with them was they were going to overtake the silver market. And when I began to explain the silver market to Wall Street Bets, they didn't understand it, right? They're not going to be able to handle the silver market because it is 5 times larger than they can ever affect the markets. This is not buying one stock. This is a massive, obviously in this situation, a metals market. It's huge, right? Yeah, and gold is huge. No matter how much you think of it is, they're not going to affect the market. You all can put all their money in, it's not going to affect it, right? And so I think learning that side of it, like we said earlier, technical analysis, learning fundamentals, learning as much as you possibly can and as fast as you can. A friend of mine is the CEO of an esports company, right? He'll always say the same thing to me. He says, look, when we were growing up, we had 3 TV channels. It was 3, in my case, 3, 6, and 12.
Right.
What's so interesting is there's not that anymore. People today, millennials and Generation Zs and Xs, they can actually absorb a whole lot more data than even we can right now these days. Today, I'm surrounded by 8 screens, right? It's all the way around me on all sides of me. But I need to have that kind of data. And when you are a new trader or an old trader or somebody who's been around from the beginning, you still need to have that data coming into you. And I think it's very important that we learn and learn and learn, because even when GME and AMC came around, we learned that there were some companies out there that were short.
Yeah,
Or
no, I
as
love
Warren
that.
Buffett says, when the tide rolls out, we know who's swimming naked.
Right. Wonderful. Well, Stephen, any questions that I have, anything that you want to share that I haven't asked before we wrap up?
Gosh, no, this has been so exciting. Thanks for having me, man.
Thank you very much for coming on, and hopefully we'll have you on again soon. I mean, this was really, really a pleasure. Thank you for sharing everything.
I'd be happy to.
Talk to you soon. Thanks, Stephen.